Alright guys, this video is going to be about how to hedge. I've been getting some questions on making a video about this. So it's basically what hedging is when you play stocks, right? Is you're taking a position on the up and the downside, right? Basically, you're protecting yourself in case if your bias, let's say, is invalidated, and then when the stock goes the other way, you can then cut or mitigate any type of losses that you might incur on your original bias, right? So I'm going to give you some real life example of what this means. So for this setup, this is a very realistic play that we could do tomorrow. This is how it would be, how I would probably do it. There's a lot of different ways you could do it. So you could basically play like a 1-to-1 hedge or a 2-to-1 hedge, 3-to-1 hedge. What that means is if you're taking, let's say, a 2-to-1 hedge, meaning let's say this is a bear flag pattern. When this bear flag breaks, at that point, that is your short entry, right? On a break of a bear flag. Now, when you take that short entry, you're going to take puts. If you were to take a hedge, you could play a hedge based on the breakdown itself. So let's say you buy a call and a put right on the spot just to protect yourself in case there's a bear trap here and then you go upside, right? Then you could just cut your put at that time and then just ride the call back up and see how you take it from there. So that's how you would do a just on a breakdown on that, right? There's also ways you can do like let's say you take the put here and then let's just say it's kind of like just hovering down here and then it starts to reverse. At that point, you don't know if it's gonna bear trap you or what. So when this stock, let's say, comes down here and then comes back up, now you got the candle close back up here. At that point, you got to make a decision. Are you going to continue holding the put that you have? Are you going to get a call to hedge at this point? Maybe you could, at that point, get a call and then hedge to protect yourself in case there's more upside, right? So that's, again, another way you could probably play a hedge and then cut your put if there's continuation, right? So that's just the basic way of how to go about hedging, and then you could use this on earnings. Sometimes earnings they'll have like various implied moves. So if there's a 10% move on a stock that's $100, that's $110 to the upside or $90 downside possibility, right? Sometimes if your bias is bullish, you can take a 2-to-1 hedge or a 3-to-1 hedge. What that means is you're taking like 3 calls and 1 put, or like whatever the balance would look like. You're gonna buy like, let's say you have let's say you want to buy like let's say 300 contracts for call side and then 100 contracts for put side. The reason why you're buying more call side is because you're more what do you call bullish bias on the upside versus the downside. And then if it does break down, then yeah, you mitigated some of your losses at that point on a breakdown. So that's basically how you can go about hedging. Again, the way I like to personally hedge, this is just me, and I like to use is I don't do it a lot, but when I do it, it's when I am expecting big moves on the up or downside, and then when I get the move, I can cut the position that's not working out. So let me give you a real life example here. Tomorrow is going to be probably set up here a breakdown on Apple. If it does break down here, what I could do, I probably won't do it, but what you could do if you were to take a hedge, a 1-to-1 hedge, which is what I like to do, you take the breakdown, take a put, okay, and then you could take a call as well, just using a very rough example, and then you see what happens. If there is continuation to the downside, right, you have your levels ready ahead of time, you cut your call hedge because the move is going down, you're starting to lose value on your call, and then you just ride the put. All right, so now for example, how I like to personally use hedging is sometimes, for example, FOMC meeting. We just had one this past week. Before the big moves happen, you take a position, regardless if you're bullish bias or bearish bias, right? So if you are bullish bias, you could again weigh your position a little bit more heavier. It really depends on each person. Again, I like to do the one-to-one. So when I'm doing the one-to-one, I'm going to take a position on a call. Let's say I'm bullish bias, I'm going to buy a call. And then based on how price is moving, it's just kind of chopping around up and down, and then it starts going up. And I'm like, okay, my position is so far okay. But then maybe something pulls back before the actual meeting happens, and then it's just like, okay, it's kind of getting sketchy here. Maybe I might buy a put as a hedge. And at that point, I'm going to take a position on a put hedge, and then I'm going to now have a call and a put hedge. Now, for a FOMC move to, let's say FOMC started, Jerome Powell is speaking, he says some great stuff, dovish price action, price just starts to skyrocket. And this has happened in the past on SPY here, where, the market just like sent, big time moves up, like price just skyrocketed up, and the value of the calls would exponentially increase by 100, 200, 300%. When you hedge a position and it starts to exceed a few 100%, your put could go to zero. Like you could lose out on the entire value of that put position, assuming you're a one-to-one hedge, and you will still profit on a 200-300% move. If you're a 100% move, you break even pretty much. But you're basically protecting yourself with a put just in case it breaks down, right? And if on an FOMC meeting type of day it breaks down, again, same scenario. It's your call. Again, you're not trying to. I'm just giving you worst case scenario if your position was to go to zero. Obviously, let's say you took the put and the call hedge here. Let's say it broke down. You're starting getting 200, 100%, 200%. You could cut your call ahead of time. Take a smaller loss. Take a 30, 40, 50% loss. That's totally okay. I'm giving you worst case scenario. Your position goes to zero on a big news event type of day like FOMC. So when that happens, again, you're going to be 200-300% profiting, and then your position, your opposite side is just mitigated, again, based on the winning that you made. So I hope that is clear on how to hedge. I suggest that, if you're going to try this, these are the times that I like to use this are maybe on a big type move type of plays. Like it could be earnings. I'm not a huge fan of earnings, but people do it on earnings, FOMC. You could even do it on big news events. The risk, this is one of the risks that you have to keep in mind with hedging, is that there is a possibility that one of your position or both of your positions, this is what I'm trying to say, both of your positions will get wrecked entirely. And what do I mean by that? Let's say FOMC, I'm going to use FOMC as an example. Let's just say FOMC started and it's just going sideways. It's actually just kind of happened. I'll just use this real life example. On the 13th, it was it the 12th? Yeah, I think it was probably right here, the 12th, yeah. So FOMC started around 2 o'clock, big dip, didn't go all the way down, bounced, dipped, bounced, that's what it did. If you were to have bought a call and a put position here, let's say you bought your call at 2 o'clock. Let's say you got ahead of time, set everything up. We actually bought calls ahead of time. I was in calls, and the thing dipped, right? Totally fine for it to dip. Let's say just pretend you had the hedge, call and put hedge. This started to dip, but let's say you did not sell. Most people, when they're hedging, they think it's just going to go all the way down, right? And that's what the anticipation was. However, it bounced. So then what? You end up holding your puts. Now you have your call and your put still at the same time. If you did sell your call on this breakdown, assuming it's gonna break down, then you just, you lost your call position, and now you're just stuck with a put. Now you're just hoping it's gonna break down, and then it starts rising up, and then that's it. You just pretty much lost your value on your put position as well. So that's a scenario I just played out that could happen. There's also the fact that it just chops. When it chops and you hedge, you are gonna get wrecked both ways. That's a possibility. It can happen, and when it does happen, that's just something to be mindful of, right? Because then you don't get a move upside or downside, and this is where bulls and bears will have failed, and the market maker tends to win during that time. So I hope this video helped. If there's any questions, please reach out. I hope this is very clear in understanding hedging, and yeah, thank you.